You're 40-something years old, and if you're honest with yourself, you're probably thinking about money a lot more than you did back in your 20s. Maybe you're wondering if you've made enough good decisions to actually retire when you want to. Maybe you're looking at your bank account and realizing that it's not growing the way you hoped it would. Or maybe you're one of the lucky ones who's done pretty well, but you're smart enough to know that getting ahead and staying ahead are two completely different things. Whatever your situation is right now, here's the truth that nobody really wants to say out loud. Most people at this stage of life are not on track for the kind of wealth they actually want. They're not broke necessarily, but they're not getting wealthy either. They're stuck in that middle ground where life is comfortable enough that they don't panic, but not so comfortable that they can stop thinking about money entirely. And that middle ground is actually dangerous because it lets you believe that things will somehow work out when they probably won't without some serious changes. That was your friend Clarence Capital. Don't forget, like this video and subscribe to the channel. The good news is that building wealth in your 40s, 50s, and beyond is absolutely possible. In fact, you've got some serious advantages that you didn't have when you were younger. You've got experience. You've got a track record. You've got, hopefully, more income than you did back then. What you don't have is time, in the same way a 25-year-old does. So you need a strategy that actually works fast. You need to understand the rules that separate the people who build real wealth from the people who just work hard, make decent money, and never seem to get ahead. This is what we're going to talk about today. These 7 rules are not theoretical. They're not something you read in a business book written by some guy who made his money back in 1987 and hasn't actually worked in decades. These are practical rules that work today, in this economy, for real people who are serious about changing their financial situation. Some of them will confirm what you already know deep down. Some of them might make you uncomfortable because you'll realize that you've been doing the opposite. And that's okay. Discomfort is actually the first sign that you're about to make a change that matters. The first rule is something that sounds simple, but almost nobody actually follows it. And that rule is this: stop being an employee. Now, I don't mean that you need to quit your job tomorrow. If you've got a salary and benefits and security, there's absolutely nothing wrong with that right now. What I mean is that you cannot build serious wealth by trading your time for a paycheck. The math just doesn't work. Let's say you make $100,000 a year. That's not bad. That's better than most people. But you're still trading your time for that money. You show up, you work, you get paid. If you stop showing up, the paychecks stop coming. That's the deal with being an employee. And no matter how high your salary goes, you're still capped by the number of hours in a day and the number of years you have to work before you need to retire. Wealthy people understand something that employees don't, and that's that your income needs to stop being directly tied to your time. Your money needs to work while you sleep. It needs to make money whether you're focused on it or not. This doesn't mean you need to become a business owner, although that's certainly one path. It could mean real estate investments. It could mean creating products or services that generate income without requiring your direct involvement every single day. It could mean buying dividend-paying stocks or building a portfolio that generates passive income. The point is that your primary wealth-building vehicle cannot be your job. Your job is what funds your actual wealth-building activities. Your job is what gives you the capital to invest in the things that will actually make you wealthy. Once you understand that distinction, everything changes. You stop being angry at work because you're not expecting work to make you rich. You stop staying at a job you hate for another 5 years just hoping for one more promotion. You see your job for what it is, a vehicle for generating capital that you'll deploy into real wealth-building activities. That's it. That's the relationship. The second rule is that you need to understand the difference between income and assets. This is where people really start to struggle. And I think it's because nobody teaches this stuff in school. Everyone tells you to go to college so you can get a good job, so you can make good money. But nobody tells you that making good money and building good wealth are not the same thing. You can make $300,000 a year and be broke in 5 years if you don't understand how to convert income into assets. I've seen it happen. Rich athletes, celebrities, high-income professionals who earn a ton of money but spend it all and end up with nothing when the income stops flowing. An asset is something that puts money in your pocket. It doesn't matter if it's real estate that generates rental income, stocks that pay dividends, a business that generates profit, or intellectual property that generates royalties. The point is that assets create cash flow. Income is what you earn from your job or your business. Assets are what you own that make money for you. And here's the thing that trips up most people. Building assets is unglamorous and slow. It doesn't feel like progress. You save up money from your job, and then you buy a rental property, and then you wait for the tenant to pay rent every month. It's not exciting. But fast forward 10 years, and you've got a portfolio of properties that generate $100,000 a year in passive income. Now you've got options. You could quit your job, you could keep working and let that income stack up, you could invest it into more assets. You've got real choices. The person who didn't do this, who spent all their income, who thought they were too busy to deal with real estate or stock portfolios, they're in the exact same position they were in 10 years ago. They're making the same money, or maybe a little more, but they've got nothing to show for it, except maybe a nicer car or a bigger house that they're still paying off. The person who converted their income into assets is fundamentally in a different position. This is why Rule 2 matters so much. You've got to stop treating income like something to spend and start treating it like raw material for building wealth. The third rule is that you need to think long-term, and I mean really long-term. Not 5 years, not even 10 years. I mean 20, 30, 40 years long-term. This is hard because we're wired as humans to think short-term. We care about what's happening this month, this year, maybe this quarter if we're thinking about business. We don't naturally think about what's going to happen in 30 years. But wealth building is one of the few things in life where that long-term thinking is absolutely critical. If you're making investment decisions based on what the news is saying this week, or what your friends are talking about, or what you read online last night, you're going to get crushed. You're going to make panicked decisions that cost you thousands or even hundreds of thousands of dollars over your lifetime. The people who build wealth are the people who make a plan and then stick to it for decades. They decide that they're going to invest in index funds or real estate or dividend stocks, and then they do that consistently for 30 years, regardless of what the market is doing. When everyone else is panicking because the market is down 20%, they're either holding steady or they're actually buying more, because they know that over the long term, markets go up. They're thinking about where they want to be in their 60s or 70s, and they're making decisions today that align with that future, even if those decisions don't feel good right now. This is boring wealth building, and it's the most reliable kind. The problem is that boring is hard. Boring requires discipline. Boring requires that you ignore all the exciting opportunities that come your way and stick to your plan. There are always people promising you that you can get rich quick, that you can multiply your money in 6 months, that you've found the secret that nobody else knows. And these people are lying, or they're selling you something. Real wealth building is steady and boring, and it takes time. And once you accept that, once you actually make peace with the fact that you're going to be boring with your money, you're going to be so far ahead of everyone else that it's not even funny. The fourth rule is that you need to understand cash flow. Cash flow is more important than profit, and it's definitely more important than net worth. Let me explain the difference. Net worth is basically what you're worth on paper. It's your assets minus your liabilities. You could have a really high net worth on paper, but terrible cash flow. That's actually what happened to a lot of people during the financial crisis. They owned real estate that was supposed to be worth a lot of money, but they couldn't sell it. And they had mortgage payments due every month. So their net worth looked great on paper, but their cash flow was terrible, and they ended up in serious financial trouble. Cash flow is the actual money that comes in versus the money that goes out. It's the money you have in your bank account right now, not the money you're supposed to have based on some calculation. If you understand cash flow, you understand how to stay afloat during bad times. If you only understand net worth, you can get wiped out really quickly. This is why understanding cash flow is so critical when you're building wealth. Before you make any investment, you need to understand what the cash flow is going to be. If it's a rental property, what's the monthly rent after you pay for maintenance and property taxes and insurance? If it's stocks, what are the dividends and what are the capital gains? If it's a business, what's the actual cash profit after you pay all your expenses? The reason this matters is because cash flow is what funds your life. If you've got a business that makes $1 million in profit on paper, but that profit is tied up in inventory or equipment and doesn't actually turn into cash that you can spend or reinvest, then that business is not helping you. But if you've got a business that makes $500,000 in actual cash that comes in regularly and predictably, then that business is genuinely building your wealth. People who understand cash flow end up making much better decisions about where to put their money, because they're looking at the actual cash that will come in, not just the theoretical value on paper. The fifth rule is that you need to have a diversified income and asset portfolio. Now, diversification is one of those words that gets thrown around a lot, and a lot of people think it just means having a few different stocks or a few different pieces of real estate. But real diversification means that your wealth is not dependent on any single source of income or any single type of asset. You've got your job, sure, but you also have real estate. You've got dividend stocks and maybe some growth stocks. You've got maybe a side business or some other income stream. The idea is that if one thing fails or underperforms, it doesn't destroy your entire financial situation. This becomes critically important when you're in your 40s and beyond because you can't afford to have a major setback. A 25-year-old who loses everything can spend 10 years rebuilding. A 45-year-old who loses everything might be in serious trouble because they don't have 10 years. That's why diversification is not just a nice idea, it's essential. You want to build your wealth across different sectors, different geographies, different types of investments. You want multiple streams of income. The exact mix depends on your personal situation, your risk tolerance, and your expertise, but the principle is the same. Don't put all your eggs in one basket. The interesting thing about diversification is that it actually forces you to think more systematically about your finances. Instead of just having one or two investments, you've got to think about how everything fits together. What percentage of your portfolio is in real estate? What percentage is in stocks? What percentage is in business? What is your total income from your job versus passive income? When you start asking these questions, you start to actually understand your financial situation instead of just bumbling through it. And when you understand your situation, you can actually plan and make improvements. The sixth rule is that you need to invest in yourself. This might seem obvious, but most people don't actually do it. Investing in yourself means education, learning new skills, building your expertise, developing relationships that matter. It might mean taking courses that cost money but will make you better at your job or better at business. It might mean hiring a coach or a mentor who can help you avoid costly mistakes. It might mean reading books and listening to podcasts and going to seminars about wealth building and business and whatever your area of focus is. The reason this is a rule is because investing in yourself has the highest return of anything you could possibly invest in. If you spend $1,000 on a course that teaches you how to negotiate better, and that helps you negotiate a higher salary or a better deal on a piece of real estate, you've just returned a year's worth of that investment in one negotiation. If you hire a coach for $5,000 and that coach helps you avoid a bad business decision or an unwise investment that would have cost you $50,000, you've just made 10 times your investment. Most people won't invest in themselves because they see the cost up front and they don't see the return. But the return is always there if you're willing to learn and apply what you learn. This is also why you're watching this video, presumably. You're investing your time to learn about wealth-building strategies. That's actually one of the smartest things you can do. You're getting access to information that could save you hundreds of thousands of dollars, or make you hundreds of thousands of dollars. And it didn't cost you anything except time. The people who take that information and actually apply it are going to build wealth. The people who watch and then go back to doing the same thing they were doing before are not going to see any change. So investing in yourself is not a nice add-on to your wealth-building plan. It's foundational. The seventh and final rule is that you need to think like an owner, not an employee, even if you work for someone else. This might be the most important rule of all, because it changes your entire perspective on money and work and opportunity. When you think like an owner, you think about value. You think about how to create more value, how to make things more efficient, how to innovate and improve. You think about long-term sustainability. You think about whether the decisions you're making today are going to help or hurt your financial situation 5 years from now. When you think like an employee, you think about getting through the day. You think about doing what you're told. You think about getting your paycheck. An owner mindset means that you're constantly asking yourself, what could I do better? Where are the inefficiencies? What's wasting my time or money? How could I create more value? How could I generate more income? An employee mindset means you do your job and you leave. The thing is, you don't have to actually own a business to think this way. You can work for someone else and still have an owner's mindset. In fact, when you do, it changes everything. You become more valuable to your employer because you're thinking about how to create value, not just how to do what you're told. You make more money faster. You spot opportunities that other people miss. You start thinking about side projects and investments that could generate income. This is actually how most self-made wealthy people think, even when they're working for someone else. They're not waiting for permission. They're not waiting for someone to tell them what to do. They're taking initiative. They're solving problems. They're creating value. And they're doing it with an eye toward eventually having their own business or building a portfolio of investments that generates enough income that they don't need to work if they don't want to. The owner mindset is what separates people who build wealth from people who never quite get ahead, no matter how much they earn. Now, here's the thing about all of these rules. They're not complicated. They're not rocket science. Most of them are common sense, if you stop and think about them. But knowing them and actually doing them are two completely different things. Lots of people know that they should stop being an employee and build multiple income streams. They know they should invest. They know they should think long-term. But they don't do it. They know they should spend less than they earn, but they don't. They know they should educate themselves, but they don't. They know they should think like an owner, but they don't. The gap between knowing and doing is where real life happens. That's where wealth is built, or where it's lost. The people who actually apply these 7 rules, who take them seriously, who make decisions based on them, those people end up building real wealth. Not someday, not when the conditions are perfect, not when they finally get that big break. They build wealth systematically by following these rules consistently over time. If you're at that point in your life where you're ready to actually do something different, or you're ready to move from the knowing stage to the doing stage, then you need to start somewhere. Pick one rule, just one. Pick the one that resonates with you most, or the one that you know you've been neglecting. If you know you need to stop being so dependent on your job, pick Rule 1. If you know you're good at making money but terrible at converting it to assets, pick Rule 2. If you're constantly getting distracted by shiny opportunities and you never stick to a plan, pick Rule 3. If you're not sure where your actual cash flow is coming from, pick Rule 4. If you've put all your eggs in one basket, pick Rule 5. If you haven't invested in yourself in years, pick Rule 6. If you've got an employee mindset and you need to shift to owner thinking, pick Rule 7. Pick one rule and commit to actually doing something about it this month, this week even. Don't try to fix everything at once. That never works. Real change comes from taking one thing seriously and doing it well, and then building on that momentum. Pick your rule, make your commitment, and actually follow through. Because here's what nobody tells you when you're in your 40s. This is actually when wealth building becomes possible. You've got enough income to actually build. You've got enough experience to avoid beginner mistakes. You've got enough time left to actually see the results of your decisions. But you've also got to actually decide to do it. The next 5 to 10 years are going to go by anyway. You could spend them doing the same thing you've always done and wonder why you're not further ahead. Or you could spend them applying these 7 rules and actually building the wealth that you want. The choice is yours, but the clock is ticking. The time to start is not next year. It's not next month. It's right now. That was your friend Clarence Capital. Don't forget, like this video and subscribe to the channel. Check out the next video, The Financial Lie We All Believe, What Average People Really Earn and Save. Take care of yourself, your finances, and most importantly, your time. Good luck.